Welcome to Griffonomics.
Glad to be here for this one.
Yeah, today we are looking at a company that is sitting on a mountain of cash so large that it could, theoretically, buy its own business outright.
Which is wild to even think about.
Right. Yet Wall Street is currently treating it like, I don't know, a toxic asset. The stock just plunged 21% in a single day.
Yeah, hitting its lowest point since August 2024.
Exactly. And the company is BioNTech, the globally recognized biotech giant famous for essentially helping save the world during the pandemic.
It was an incredibly violent reaction from the market, honestly. When a multi-billion-dollar company loses a fifth of its value overnight,
It sends shockwaves everywhere.
it really does. It ripples through the entire sector.
Which is exactly why today's sources are so critical for us. We're looking at a stack of freshly released financial reports, the March 10th, 2026 earnings call transcripts, and some very compelling contrarian investor analyses.
Lots of data to sift through.
So much data. But the mission of this deep dive is to execute a granular investigative report on BioNTech's transformation. They are moving from a COVID-19 vaccine manufacturer into a tumor-centric oncology powerhouse.
Which is a massive pivot.
It is.
Yeah.
And we need to figure out, is the market panicking appropriately, or are they missing a massive asymmetrical opportunity? Okay, let's unpack this. Lay out the foundation for us. Before we even talk about the crash, what is BioNTech actually building?
Well, to understand the market's reaction, you first have to really understand BioNTech's core business strategy, which has been shifting under the surface for the last few years.
Right, they haven't just been sitting still.
Exactly. They are taking the massive high-margin revenues from their Comirnaty COVID-19 vaccine franchise, the financial engine we all know them for.
The cash cow.
Yeah, the cash cow. And they are using it to fund a decade-long ramp-up in cancer research. Their stated goal is to become a multi-product oncology company by 2030.
And looking at the clinical roadmaps, they aren't just throwing money at random cancer trials.
Not at all.
They are building this highly integrated machine leaning on three pillars of innovation. So that's next-generation immunomodulators, antibody-drug conjugates, or ADCs, and mRNA cancer vaccines.
Yes, those three pillars are key.
But before we go any further, let's break some of that down for the listener because, the mRNA part makes sense, right? That's the COVID vaccine tech applied to cancer.
Right. People are familiar with that now.
But what exactly is an ADC? Let's not gloss over that.
That is a crucial point to clarify. Think of an antibody-drug conjugate, an ADC, as like a guided microscopic missile.
Okay, guided missile.
Yeah. In traditional chemotherapy, you flood the whole body with toxins, which kills cancer cells, but also damages healthy tissue.
Which is why patients lose their hair and get so incredibly sick.
Exactly. But an ADC completely changes the game. You have an antibody that acts as the navigation system. It's designed to seek out and bind only to a specific target on a cancer cell.
So it ignores the healthy cells.
Right. And attached to that antibody is a highly toxic chemotherapy payload. So it carries that payload directly into the cancer cell and releases it. It effectively destroys the tumor from the inside without carpet bombing the healthy tissue around it.
Wow. That makes perfect sense. So they have these guided missiles, the mRNA vaccines, and immunomodulators, which tweak the immune system's response.
Yep.
And the sources highlight that they are combining these three pillars to build what they call a synergy-driven moat.
They are. They're systematically designing these different modalities to be combined with one another because, tumors are incredibly smart.
Really, they mutate.
They mutate, and they find ways to naturally resist single drug treatments. So BioNTech is engineering therapies meant to be taken together to just cut off those escape routes entirely.
I was actually trying to visualize the sheer scale of this business pivot, and I came up with an analogy. Tell me if this works.
Let's hear it.
It's like looking at a tech company that released a blockbuster smartphone. That's the COVID vaccine. It changed the world, generated billions in profit, but instead of just making, slightly better smartphones every year, they took all those profits and secretly bought an island to build a sprawling, futuristic artificial intelligence city.
I like where this is going.
And that city is the oncology pipeline. They engineered the new city's infrastructure so that all the buildings physically interact with each other. That's the synergy-driven moat.
What's fascinating here is that BioNTech isn't just making off-the-shelf drugs, but engineering molecules specifically designed to be combined to overcome tumor resistance. Your analogy perfectly captures that structural integration.
But when we zoom in on the actual biology, like how they are engineering the infrastructure of that new city, I think we need a more mechanical metaphor.
Oh, definitely.
Let's look at their cornerstone asset, pumitamig alpha. It's a bispecific antibody. It sounds like they are building a multi-tool to pick a very complex lock.
That's exactly what it is.
If a tumor mutates to block the front door, the drug is already simultaneously breaking in through the back window.
And if you examine the molecular mechanism of pumitamig, it's brilliant. Let's break down those doors and windows. Most standard immunotherapies target one thing.
Like just the front door.
Right. For example, they might target a protein called PD-L1. Tumors use PD-L1 like an invisibility cloak to hide from the immune system. Standard drugs strip that cloak away.
Okay, so the immune system can see the tumor again?
Yes. Pumitamig does that, but it also simultaneously targets VEGF-A.
And VEGF-A is what tumors use to build their own blood vessels, right? They essentially hijack the body's plumbing to feed themselves.
Precisely. So pumitamig strips the invisibility cloak and cuts off the blood supply at the very same time.
That's incredible.
But the real magic isn't just that it does two things. Because it physically binds to both targets simultaneously, it creates a unique, heavy, complex formation.
Wait, a heavy, complex formation? What does that do?
That heavy structure triggers the tumor cell to rapidly pull the drug directly inside itself. A standard doctor's cocktail of two separate drugs just floating around in the bloodstream. It cannot replicate that specific localized mechanism.
It's actively forcing the tumor to swallow the poison.
Exactly.
And then connecting back to that synergy moat, they plan to eventually combine pumitamig with their mRNA vaccines.
Yes. And the mRNA pipeline itself is split into two really fascinating tracks. You have FixVac, which is an off-the-shelf vaccine targeting shared tumor antigens.
So targeting common red flags that show up on specific types of cancers?
Right. They currently have one in a phase 3 trial for HPV-positive head and neck cancer. But then they have iNeST, which, it just pushes the boundaries of modern medicine.
Individualized neoantigen-specific immunotherapy. To put it plainly, it is a vaccine custom-built for the unique mutations of a single patient's tumor.
It sounds like science fiction, but it's real.
They sequence your specific cancer, use AI to identify the most vulnerable targets, and manufacture a bespoke mRNA vaccine just for you.
It is the ultimate expression of personalized medicine. So you have this fully funded, synergy-driven pipeline designed to fundamentally change how we treat cancer.
Which brings us to the core mystery of this deep dive. If this visionary science sounds incredible and the mechanisms are this advanced, why did the stock just fall off a cliff?
Yeah, the 21% drop.
A 21% drop in a single day is violent. Why is the market running away from this?
Well, the crash was triggered by a major leadership announcement. Co-founders Ugur Sahin, the CEO, and Özlem Türeci, the chief medical officer.
The husband and wife team who literally built the company.
Right, the ones who guided the COVID vaccine to the world. They announced they are stepping down from their operating roles by the end of 2026.
Wow.
Yeah, they are leaving to start a brand new, independent biotechnology company focused on what they call next generation, everything in the mRNA space.
I hear the spin-off argument from the sources, but let's be real for a second. Think about how you, listening to this, how you'd react if the visionary founders of a company you invested in suddenly announced they were leaving right before the most critical product launches in the company's history.
It's alarming.
You'd probably get the sell button too, right? Why shouldn't investors view this as the founders abandoning ship before the trials potentially fail?
And that is the exact execution gap risk that Wall Street is terrified of right now. BioNTech is entering a window where they expect 15 or more critical phase 3 trial readouts between 2026 and 2027.
15 phase 3 readouts. That is massive.
It is. Transitioning management during the biggest commercial pivot in a company's history looks incredibly risky. But the contrarian analyst reports provide a strong counter-narrative.
Okay, what's the defense for leaving at such a critical moment?
It comes down to skill sets. Sahin and Türeci are natural early-stage innovators. They stated they are ready to become pioneers again. They want to get back to the lab and focus on discovery.
Instead of running a massive corporation.
Exactly. BioNTech has outgrown its startup phase. It now needs to hyper-focus on late-stage clinical execution, navigating the FDA, and running massive global commercial supply chains.
So by stepping away, the founders get to innovate freely.
And BioNTech's board can bring in executives with deep, specific commercial launch experience.
And the financial structure of the separation is what really caught my eye. BioNTech is not handing over a massive pile of cash to fund this new venture.
No, not at all.
Instead, they are contributing related rights and early-stage mRNA technologies. In exchange, BioNTech gets a minority stake in the new company.
Right.
So BioNTech retains its entire core oncology pipeline, gives away no cash, and still gets a piece of whatever next-generation breakthroughs the founders invent next.
That structure does mitigate some risk, for sure.
Yeah.
But Wall Street is also reacting to immediate, tangible downside pressures, specifically what analysts are calling COVID-19 decay.
The shrinking financial engine.
Yep.
Because BioNTech's 2026 revenue guidance came in much lower than expected, they are projecting revenues of roughly 2 billion to 2.3 billion euros.
And the consensus on Wall Street was closer to 2.75 billion.
Right. The decline is happening faster than modeled.
It is, and that's because the COVID vaccine market is shifting dramatically. We are moving away from massive multi-year government contracts in Europe, and in the U.S., the transition to the private market has introduced fierce competition. The reliable cash cow is fading.
And then there is the risk of clinical obsolescence, which is just a terrifying concept for biotech investors.
Oh, absolutely.
Your science might be groundbreaking, but the medical landscape moves so fast that your drug might become obsolete before it even finishes testing.
We saw a prime example of this just recently. BioNTech and their partner had to completely discontinue a phase 2 trial for their individualized iNeST vaccine in urothelial carcinoma, a type of bladder cancer.
Wait, did the vaccine fail? Like, was it unsafe?
Neither. The standard of care for that specific bladder cancer shifted so rapidly with new treatments hitting the market that the trial design itself was no longer viable.
Wow.
Yeah, they couldn't ethically or practically compare their vaccine to the old standard anymore.
You just mentioned they had to scrap an entire phase 2 trial because the medical landscape shifted.
Yeah.
That highlights how incredibly expensive and risky oncology is.
It's a brutal space.
A smaller biotech would be utterly bankrupt after a clinical failure like that. How on earth is BioNTech surviving this cash burn, especially with their COVID revenues shrinking faster than expected?
That leads us to the financial realities of their fiscal year 2025 review. They reported an unexpected Q4 net loss of $326 million.
Oh.
Yeah. When people read headlines about missed revenue guidance and unexpected quarterly losses, they picture a company in financial distress.
Here's where it gets really interesting. You look at the balance sheet from that same 2025 review, and BioNTech is sitting on $18.4 billion in cash, cash equivalents, and security investments.
It is the absolute definition of a fortress balance sheet.
$18.4 billion.
To put that in perspective, after the 21% stock crash, BioNTech's entire market capitalization hovered right around $20 billion to $22 billion.
Meaning their cash pile almost entirely matches the value of the whole company.
Exactly.
Which means they have enough capital to fund their operations for an entire decade without needing to dilute shareholders or take on bad debt.
They are incredibly well capitalized.
And they aren't just hoarding it either. Let's look at the strategic pipeline forensics. They are deploying that cash to build a highly de-risked clinical portfolio. Take the Rosetta program.
Yes, the Rosetta program. That is the clinical roadmap for pumitamig, that bispecific multi-tool antibody we discussed earlier.
Right.
By the end of 2026, BioNTech expects to have 8 global phase 3 trials ongoing just for pumitamig, targeting lung, breast, and gastrointestinal cancers.
Running 8 phase 3 trials simultaneously is a staggering clinical load. I mean, that costs an astronomical amount of money.
It does. But if we connect this to the bigger picture, BioNTech isn't shouldering that burden alone. The commercialization and development of pumitamig is partnered 50-50 with Bristol Myers Squibb.
BMS, one of the biggest pharmaceutical heavyweights on the planet.
Yep.
Why does that matter so much to the investor thesis?
Because BMS is splitting the cost of these trials right down the middle, and they will split the gross profits 50-50. This partnership is a massive external validation of BioNTech's science.
BMS looked at the data and decided it was worth billions of their own dollars.
Exactly. It dramatically de-risks BioNTech's clinical execution, and it protects their profit and loss statement from the brutal expenses of late-stage trials.
And pumitamig isn't their only shot on goal. Let's look at gotistobart.
Yeah.
This is their CTLA-4 targeting antibody. The phase 3 data they presented for this drug in second-line squamous non-small cell lung cancer was remarkable.
It really was.
But before we get into the data, let's translate that medical jargon. Second-line squamous non-small cell lung cancer Means we're talking about patients with a tough-to-treat form of lung cancer who have already failed their first round of standard therapies, correct?
Yes, this is a patient population with very limited options and typically poor outcomes. And yet, the data showed a staggering 54% reduction in the risk of death compared to standard chemotherapy.
A 54% reduction is massive.
It's game-changing.
But immunotherapies that target CTLA-4 usually come with a catch, right? Like, they take the brakes off the immune system so aggressively that the body starts attacking its own healthy organs.
That's the historical problem, yes.
Wait, so how does gotistobart not attack the whole body?
This is one of the most elegant pieces of engineering in their pipeline. Gotistobart is designed to be pH sensitive.
How interesting.
Tumors actually create their own highly acidic microenvironment to protect themselves. BioNTech engineered this drug so that it stays relatively dormant in your healthy, normal pH bloodstream.
So it's just floating around harmlessly.
Exactly. It only turns on and selectively depletes the immunosuppressive cells when it hits the acid of the tumor. It effectively uses the tumor's own defense mechanism as the trigger to destroy it.
That is brilliant. It localizes the attack and spares the rest of the body.
It's a huge step forward.
And then you add in their ADC velocity. They're targeting a...
Right.
We have a sudden founder transition that triggered a violent 21% stock crash. We have shrinking COVID revenues, but we also have a fortress balance sheet of $18.4 billion and a pipeline validated by giants like BMS.
It's a lot of conflicting signals.
What is the ultimate takeaway for you, the listener, tracking this space?
It leads us directly to the contrarian case. A lot of analysts are currently looking at this situation and rating BioNTech as a deep value or contrastive buy.
And the thesis is entirely based on the raw math of the sell-off, isn't it?
Entirely. Because the stock has crashed to the point where the total market cap is hovering right around their $18.4 billion cash value, the market is effectively assigning a value of 0 to the entire oncology pipeline.
That is the free option thesis. For an investor buying into BioNTech at this suppressed level, you are essentially buying a mountain of cash at face value.
Yes.
And as a bonus, you get a free option on one of the most advanced, catalyst-rich cancer pipelines in the world.
It's exactly the case. The cash acts as a concrete floor. It provides downside protection because the company is fully funded for a decade. Meanwhile, the 15-plus Phase 3 trials expected to read out over the next few years provide massive asymmetrical upside.
Because if even a fraction of those trials result in approved drugs, a pipeline currently valued at 0 suddenly becomes worth billions.
The broader market is currently punishing BioNTech because they're viewing it strictly as a declining respiratory vaccine company.
They see the COVID revenues dropping, they see the famous founders stepping out of the CEO and CMO roles, and they panic.
Yeah, but in doing so, they are completely ignoring its rebirth as an oncology powerhouse.
They are missing the futuristic AI city because they are too focused on the declining sales of last year's smartphone.
It's a classic case of market myopia. The short-term uncertainty of the founder transition and the COVID decay is completely blinding the broader market to the long-term fundamentals of the oncology data.
It really is a fascinating strategic inflection point. But before we wrap up, I know you're looking at the broader implications of how this founder transition is playing out across the industry.
Yes, this raises an important question that extends far beyond BioNTech's specific financial reports. Could this founder spin-off model become the new blueprint for biotech innovation?
Walk me through that. Why would this be a model for others to follow?
Well, think about the typical life cycle of a successful biotech founder. They're usually brilliant scientists who invent something incredible in a lab.
Right.
But as the company grows and goes public, they're forced to become corporate bureaucrats. They spend their days managing commercial supply chains, dealing with global pricing negotiations, and hosting quarterly earnings calls.
They get pulled completely away from the science that made them successful in the first place.
And that stifles innovation. But what biotech is doing here is radically different. What if, instead of trapping your best innovators in the boardroom, you set them free?
You let them start Company 2.0.
Yes, to chase the next massive medical breakthrough, while the original company retains a financial stake and focuses purely on late-stage execution and commercialization.
Wow.
It might actually be the healthiest possible life cycle for medical breakthroughs. It allows the pioneers to keep pioneering without risking the commercial execution of the current pipeline.
That changes the whole perspective of the transition from a glaring risk to a brilliant strategic feature. Thank you for joining us on this deep dive as we investigated the numbers, the science, and the strategy behind this massive biotech transformation. risk defined, portfolio protected.